Have you ever stared at your trading platform, watched your exact stop loss get hit, and then immediately entered another trade out of pure anger, knowing it violated every rule you set for yourself? You're not alone. Most traders struggle not because they lack a profitable strategy, but because they lack the psychological resilience to execute it when the pressure peaks. Welcome to a journey inside the human mind under financial stress. Today, we're dissecting the invisible forces that drive your decisions in the markets, exploring why you break your own rules, and how you can reclaim control over your capital. Let's start with a fundamental truth about human nature. The market is not just a battle of numbers, charts, and liquidity pools. It is a mirror reflecting your deepest fears, your ego, and your unresolved psychological triggers. When you sit in front of those glowing monitors, your brain doesn't process data like a cold computer algorithm. Instead, it operates through a primitive survival mechanism designed thousands of years ago for physical danger, not for navigating complex financial instruments. Imagine you're walking through a dense forest and you suddenly spot a predator. Your brain instantly floods your body with adrenaline and cortisol. Your heart races, your vision narrows, and you either fight, take flight, or freeze. Now, translate that exact biological response to the trading screen. You enter a position. The market starts moving against you. Your unrealized loss grows larger by the minute. To your ancient brain, that red number on the screen isn't just money disappearing, it's a direct threat to your status, your safety, and your survival. In that exact moment, higher-level cognitive thinking completely shuts down. The prefrontal cortex, which handles logic, planning, and long-term risk management, goes offline. The amygdala takes the steering wheel. And what does the amygdala want? It wants immediate relief from pain. It wants to recover what was lost right now, regardless of the cost or the probability of success. This is why you break your rules. You don't break them because you're lazy or undisciplined in everyday life. You break them because your nervous system has been hijacked by a chemical storm. Let's look at a practical, everyday example to make this crystal clear. Picture driving a car on a highway. You know the speed limit is 65 miles per hour. You made a firm mental commitment to never exceed it because you want to avoid speeding tickets and accidents. It's a sensible, logical rule. But then, another driver cuts you off aggressively. Suddenly, a hot wave of anger surges through your chest. You stomp on the gas pedal, weaving in and out of traffic, chasing that car just to prove a point. You completely forget your rule. You ignore the danger. That is precisely what happens when you experience a sudden losing trade. The market cuts you off, your ego takes a hit, and your logical trading plan flies out the window. To bridge the gap between knowing what to do and actually doing it, we must first examine the concept of rules themselves. Most traders treat rules as a rigid cage designed to restrict their freedom. They view their trading plan as a warden keeping them from making money. But a true professional views a trading plan in an entirely different light. For an elite trader, rules are not a cage, they are an autopilot system designed to protect you from yourself during moments of high emotional volatility. When you are calm, rational, and objective, you write the rules. You define your max daily loss, your risk per trade percentage, and your exact setup criteria. You do this precisely because you know that future you will be emotional, biased, and desperate when things go wrong. Future you cannot be trusted. Therefore, present you must build an ironclad framework that leaves zero room for real-time negotiation. Think of it like building a bridge. You don't calculate the load-bearing capacity of the steel beams while a heavy truck is actively driving across them. You engineer the bridge beforehand, using rigorous mathematical principles, factoring in worst-case scenarios, storms, and heavy traffic. Once the bridge is built, you trust the engineering. You don't start removing bolts mid-crossing just because you feel like the truck is moving too slowly. Yet, this is exactly what struggling traders do every single day. They modify their stop-loss while the trade is actively running against them. They move their profit targets further away because they hope the market will bounce. They negotiate with the chart in real time, completely abandoning the structural integrity of their original plan. Let's break down why this psychological breakdown happens through the lens of dopamine and intermittent reinforcement. The financial markets are the greatest slot machines ever invented. In a standard casino, you pull a lever and wait a few seconds for the reels to stop. In the market, you click a button and watch the price tick up and down in real time, creating a continuous feedback loop of intense anticipation and immediate reward or punishment. When you win a trade, your brain receives a massive dopamine hit. You feel invincible. You feel like a financial genius who has finally cracked the code of the universe. That feeling is addictive. And just like any other addiction, when you experience a loss, your brain demands another hit to restore that previous state of euphoria. This leads directly to revenge trading. You take a trade not because the setup matches your edge, but because you need to feel the emotional validation of winning again. You are no longer trading to build long-term wealth, you are trading to regulate your emotional state. And the market will happily take every single penny from a trader who treats it like a therapy session. To overcome this, you must separate your self-worth from your trading results. This sounds simple on paper, but it is perhaps the hardest psychological hurdle for any trader to clear. Society teaches us to equate our value with our financial success. If you make money today, you are smart and successful. If you lose money today, you are a failure. When you internalize this false narrative, every single losing trade feels like a personal attack on your identity. No wonder your nervous system panics. No wonder you hold on to losers until your account is nearly empty. You are fighting for your very sense of self-worth on every single pip. Professional traders understand a profound distinction: a trade is just a statistical sample. Just like a casino owner doesn't take a losing hand of blackjack personally, a professional trader accepts that losses are simply the cost of doing business. They are business expenses, no different than rent for a retail store or inventory for an e-commerce brand. If a store owner buys inventory that doesn't sell, they don't cry in the corner questioning their worth as a human being. They write it off as a bad batch, adjust their data, and move on to the next product. You must cultivate this exact emotional detachment toward your trades. Let's examine how cognitive biases further sabotage your discipline. One of the most dangerous traps is confirmation bias. Once you open a long position, your brain actively filters out any information that suggests the market is going down. You ignore bearish divergences on the RSI. You dismiss breaking news about negative economic data. You fixate entirely on that one bullish tweet or that single green candle on the 1-minute chart, convincing yourself that your thesis is still valid. Your mind becomes an echo chamber designed to protect your fragile ego from the painful admission that you were wrong. But the market does not care about your opinion. The market is completely indifferent to your hopes, your dreams, and your account balance. The sooner you embrace this brutal reality, the sooner you can stop arguing with the charts and start flowing with reality. Discipline is not about forcing the market to bend to your will. Discipline is about bending your own behavior to align with the unyielding reality of price action. Another major obstacle to maintaining discipline is the illusion of control. Human beings desperately want to feel like they are in control of their environment. In everyday life, hard work and preparation usually lead to predictable outcomes. Study hard for an exam, get a good grade. Work extra hours, get a promotion. But the financial markets operate on probabilities, not certainties. You can do everything right, follow your checklist, manage your risk, enter at the exact right spot, and still lose the trade due to random market noise or unexpected geopolitical events. Conversely, you can break every rule in the book, enter a terrible trade based on a gut feeling, and make a massive profit because you got lucky. This random reinforcement is the most dangerous trap in trading. When you break your rules and win, your brain records a dangerous lesson: breaking the rules works. It reinforces bad habits and sets you up for a catastrophic loss down the road. True discipline means accepting that you cannot control the outcome of any single trade, you can only control your process and your execution. If you focus exclusively on executing your edge flawlessly, the profits will eventually take care of themselves as a byproduct of statistical probability. Let's look at how you can practically implement this mindset shift into your daily routine. First, you need to establish a pre-market ritual. Just as an elite athlete doesn't walk straight off the couch and onto the Olympic track without stretching and warming up, you should never open your trading platform without a mental warm-up. Spend 20 minutes reviewing your trading rules, meditating, or journaling about your current emotional state. Are you feeling rushed? Are you trying to make back yesterday's losses? Are you stressed about personal finances outside of trading? If the answer to any of these questions is yes, close the platform. Do not trade that day. Protecting your capital starts with protecting your mental state. A clear mind is your ultimate trading edge. Second, implement hard technological barriers to protect yourself from your own impulses. If you know you struggle with overtrading, set a maximum daily loss limit directly with your broker or prop firm that locks your account for the rest of the day once hit. Do not rely solely on willpower. Willpower is like a muscle. The more you use it, the more fatigued it becomes. By the end of a long trading session, your willpower reserve is completely drained. That is why the biggest mistakes almost always happen in the final hours of the day. Automate your discipline. Let code and software do the heavy lifting when your psychological stamina runs out. Third, keep a detailed trading journal that records not just your entry and exit prices, but your exact emotional state during the trade. Write down what you were feeling when you entered. Note whether you felt calm and detached, or anxious and rushed. Over the course of 50 to 100 trades, patterns will emerge. You will clearly see that your biggest losses almost always correlate with emotional states of anger, boredom, or impatience. Data removes emotion. When you stare at cold, hard statistical proof that breaking your rules always leads to a ruined week, your rational mind finally accepts what your emotional mind tried to deny. Discipline is not a fixed personality trait that you either have or you don't. It is a daily practice, a muscle that must be trained through continuous awareness, rigorous boundaries, and radical honesty with yourself. The next time you feel that sudden surge of adrenaline telling you to ignore your stop loss, or to take one more trade just to get even, pause. Step away from the screen. Breathe. Remember that every time you surrender to that impulse, you are strengthening the habit of failure. But every time you walk away, accept a small loss, and protect your capital, you are forging the ironclad mindset of a professional trader. Master your emotional impulses before the market masters your account.